Hello and welcome to the IFRS 17 training series. In this video, we will cover onerous contracts and loss components. First, we'll start off with a reminder of the definition of a contractual service margin. IFRS 17 defines the CSM as a component of the carrying amount of the asset or liability for a group of insurance contracts representing the unearned profit the entity will recognize as it provides services under the insurance contracts in the group. Or in other words, the CSM is just the unearned profits for a group of contracts. The CSM is established when, on initial recognition of a group of insurance contracts, the sum of the following results in an expected net cash inflow. So your fulfillment cash flows, plus any derecognition of any asset or liability recognized for insurance acquisition cash flows prior to initial recognition, and any cash flows arising from the group on the date of initial recognition. Or in other words, the PV of your outflows minus the PV of any inflows, such as say premium, plus your risk adjustment has to be less than zero, or a negative number. And that would result in a CSM. Now, there are two outcomes when you have a new group of policies at initial recognition. You could have that formula being less than zero, where you'd have a CSM, or you could have it being greater than zero, where you have a loss component. And that's what we're going to talk about for the rest of this video. In this case, your PV of your outflows, such as your claims and expenses, are higher than your PV of your inflows or your premiums, plus your risk adjustment. So let's go through two quick scenarios. So scenario one, assume we have PV of outflows of 80, PV of inflows of 100, and a risk adjustment of 10. So using our formula, we can take our PV of outflows 80 minus our PV of inflows 100, that gives us negative 20, plus our risk adjustment of 10 gives us negative 10. And since this is negative, that means we have profit in the product, or we have a CSM of 10. And you can think of this as the PV of outflows is your claims and expenses of 80, and you're charging $100 to the consumer for this, so you expect to earn about $20. Then you set up a risk adjustment of 10, so you still have about earnings of about $10 of profit. In scenario 2 here, we have PV of outflows of 95 and PV of inflows of 100. In this case, we still have our premiums of 100 being greater than our outflows of 95. So this product would still be profitable on an expected basis. But once you add the risk adjustment, it actually flips the sign to a positive number. So 95 minus 100 plus 10 is 5. And since this is positive, we have a loss component. So when there's a loss component, that means that the group of contracts that we're looking at are unprofitable, and these are known as onerous contracts. Onerous contracts occur when, on initial recognition of a group of insurance contracts, the sum of the following results in an expected net cash outflow. So again, our fulfillment cash flows, any derecognition of any asset or liability recognized for insurance acquisition cash flows prior to initial recognition, and any cash flows arising from the group on the date of initial recognition. Or in other words, our PV of our outflows minus our PV of our inflows plus the risk adjustment is greater than zero, or we have a loss component. So a group of insurance contracts can also become onerous, or technically more onerous, after initial recognition of the group as well. So at a later date in time, what was once a profitable group can become a onerous group of contracts. And this would occur if the CSM balance goes negative in a period, or in the case of becoming more onerous, when the loss component goes more negative. And this could occur from unfavorable changes to the fulfillment cash flows due to changes in the best estimate liability or the risk adjustment, such as unfavorable experience emerging, unfavorable assumption changes that are put through by the appointed actuary on the best estimate liability or the risk adjustment. Those could cause the CSM to go from a positive balance to a negative balance and create a loss component. So the entity shall establish or increase a loss component of the liability for remaining coverage for any onerous groups. And the loss component determines the amounts that are presented in profit or loss as reversals of losses on onerous groups and are consequently excluded from the determination of insurance revenue. That's pretty jargony, but basically what it means is we want to set up a loss component and then systematically allocate it to the income statement so that it doesn't make our income statement look weird. And we'll go through an example of how that looks. Loss components are recognized immediately in the income statement and are not deferred like the CSM. So this creates a disconnect in that CSM is deferred and recognized over the life of the contracts, but any loss components are immediately recognized into the income statement. A loss component can be established at the inception of a group of contracts, as we mentioned, or subsequently if a group that had positive CSM flips to a negative balance due to any adverse experience that emerges. And loss components can also flip back to a CSM if favorable experience emerges. So loss components must be tracked and rolled forward each period, much like CSM balances are tracked and rolled forward each period. So now let's go through an example to show how the loss component works on the income statement or statement of financial performance. Suppose that you have a 2-year product with premiums of $5 each year. The actual claims that occur in year 1 are $30 and in year 2 are $70, and this is known at issue and a loss component is set up. And we'll ignore any discounting or risk adjustments just to make this simpler. So now we'll use our formula, and our loss component is the PV of outflows minus the PV of inflows plus our risk adjustment. And our outflows are the $30 of claims in year 1 and $70 of claims in year 2. Again, we're ignoring discounting. Minus our PV of our inflows, which was $5 of premium in the first year and $5 of premium in the second year. So we get 100 minus 10 is $90, which is greater than 0. So we have a loss component. So first we'll show the insurance service result with no systematic allocation of the loss component. If you remember back a few slides, that jargony bullet point, I'll show you what that bullet point actually does. So first, let's assume that we're not going to allocate any loss component systematically to the statement of financial performance or the income statement. So first, at inception, we're going to set up our loss component of $90. So we're going to establish our loss component, and our insurance service result will be negative $90 at issue. Or in other words, we have a $90 loss as soon as it occurred. In year 1, we have $30 of expected claims, and that is because we had actual claims of 30 and our expectation of those is also 30. So we're assuming that there was no variance between those two. So our expected claims are 30 and our actual claims were 30. So the net result, insurance service result, is 0. In year 2, again, we have $70 of expected claims. We assume that it is the same on the actual basis. There's no variance in those claims. So our actual claims are 70 and our expected claims are 70, and our insurance service result is again 0. So claims emerged exactly as we thought at the beginning, at the inception of the contract. And so our insurance service result over the 2-year period is a loss of negative $90. So what's the problem here? Well, we have revenue of $100 when we only really received $10 of premiums, $5 in the first year and $5 in the second year. So this is a pretty strange result with our insurance revenue being $100 when all we did was collect $10 in premiums. On the insurance service result, we have expenses of $190 when we really only had claims of $100. So again, this is a pretty strange result. Even though the end result is still an insurance service result of a loss of $90, the income statement presentation is confusing. It doesn't tie to the actual economics. So now let us construct the statement of financial performance or the income statement for this example, but we're going to systematically allocate the loss component to the income statement. And we're going to use a simplified formula or the systematic allocation ratio, which would be the loss component at the beginning of the period divided by the present value of our expected claims and expenses. And we're going to use that ratio to allocate the loss component and amortize that loss component down over time through the 2 years. So now we have a slightly different income statement, but we still have our expected claims of 30 and 70 in year 1 and 2, our establishment of the loss component of $90 at inception, but we have 2 new lines, the amounts allocated to the loss component and the reversal of the loss component. So this first year of negative $27, what this is we're going to use our allocation formula, and we're going to allocate the loss component to that period with this formula. So we're going to take our expected claims, 30, times our beginning of period loss component balance, 90, divided by the present value of our expected claims, 30 plus 70, so that's 100. So we're going to take 90% of this 30, which is 27. So we're going to take that off of our expected claims here, and we're going to add it into the insurance service expense with the reversal of the loss component. So what that does is it changes our insurance revenue to just $3 in the period. So 30 minus 27 is $3. And then the insurance service expense would be the actual claims of negative 30 plus this reversal of the loss component 27, which gives us negative $3. In the next period, we do the same thing. Now, we had a $90 balance of our loss component. We amortized 27, so we have $63 left. So if we apply the formula, we have $70 of claims times the prior balance of the loss component, which was now 63, divided by the expected future claims, which is just 70. So now we get $63. So we're going to allocate that to the period 2 here for the loss component, and that's going to take our $70 expected claims minus 63 gives us $7 of insurance revenue. And the same thing on the insurance service expense. We have our actual claims of 70, reversal of our loss component of 63 gives us a insurance service expense of negative 7. And then you can see our loss component was negative 90, negative 63, and now we've amortized the full amount and it's $0. So if we look at this from a revenue side of things, our total revenue for the period is $10. And that is made up of the 2 premiums we received. $5 and $5 was also 10. But we're earning it based off of the claim pattern of 3 and 7. So a little bit more, it's definitely tied to the economics of the problem, but by allocating the loss component, we're better able to state our revenue for the period, $3 and $7. On the insurance service expense side, we have a loss of $100, and that makes sense because we paid $100 in claims, and that's made up of our establishment of the loss component of $90, as well as the allocation to year 1 and 2 of $3 and $7. The insurance service result by year is an immediate loss of $90 and then no income in year 1 or 2 because claims emerged exactly as we expected them to. So we still get an insurance service result of negative $90, but our revenue is $10, which is tied to the economics of receiving $5 and $5, and negative $100, which is tied to the claims that we paid of negative 30 and negative 70. So that's the reason why we want to allocate or systematically allocate the loss component to the period of time in the future to make our income statement tied to the economics of the problem. Well, thank you for watching, and tune in more to learn more about our IFRS 17 topics in our IFRS 17 training series. Thanks.